Welcome to the ultimate first-time home buyer's guide. Whether you're just now beginning to even think about buying a home, or you're already out there looking at homes, there's going to be something of value here for everyone. Home buying is actually an incredibly easy process, and there is absolutely no reason to be stressed at any point. So that's my goal here today, to remove all of the mystery and answer all of the questions you may have about the home buying process, because in reality, home buying should be an incredibly easy, fun, and rewarding experience, and I don't want anybody to miss out on that. My name is Michael. I own a local real estate brokerage here in the Dallas, Texas area. And if you're looking to move to Dallas, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Now, this is going to be a long video. There's no way around it. So don't be afraid to use the chapters featured down below if you're short on time and need to skip around. But ultimately, if you'll invest the time to watch this entire video, there is a ton of knowledge in here, and I promise it'll be well worth your time. You're also going to want to grab something to take notes with, and probably a coffee and some water. Well, let's go ahead and jump right in with step one. Step one is getting your finances in order. Don't even think of logging into Zillow until you've got a solid budget nailed down. And there are only two numbers you'll need to know right now, and neither one of them is the purchase price. The first is how much total cash do you have to put towards this transaction. Don't worry about how it's being spent yet. Just figure out how many actual dollars do you have allocated for this transaction. The second is, what is the absolute top monthly payment I'm willing to pay for the perfect dream home? And this number includes your mortgage, your taxes, your insurance, and your HOA if you have one. And I need to make a note right here, stop looking at online mortgage calculators. Most of them assume 20% down, and many of them estimate only the principal and interest portion of the loan. So it tricks you into thinking you can afford way more house than you actually can. If you don't accurately add your local taxes, insurance, and HOA, it's gonna make you think you can afford hundreds of thousands more house than you can. I've had to break this news to so many buyers that were all excited because Zillow's calculator had told them they could afford this great expensive house, and in reality it was telling them way more than they could afford. So I've developed my own calculator to help you very accurately estimate the maximum amount of home you can afford based on your specific situation and financial comfort level. It's totally free for you, and we're going to walk through it all together here in a few minutes. I know that many of you don't want to reach out to a lender yet because you might not even be sure if home buying is a good option for you, but you'd still like to have a really good idea of maybe how much home you could afford if you were to be in the market today. This is the calculator for you. And I know that many of you are thinking, but I don't want to pay the absolute top monthly payment I'm willing to go to. In fact, I don't even want to think about that number. I just want the nice comfy payment that feels low and safe in my mind. And that is perfectly understandable, but you still need to know what the actual top number is so that you can work backwards from there and make sure you're looking actually in the right price range. Let me tell you a quick story. I had a couple meet with me earlier this year after they had looked at over 30 homes with a different agent. They told this agent they wanted to buy a home under $450,000. So he kept sending them homes under $450K, and they felt like he just wasn't getting it. So I asked them the same two questions I'm asking you today. What is your max monthly payment for the perfect home, and how much total cash do you have to put towards this transaction? I then had them describe to me their dream home and their dream location. Within 10 minutes of meeting them, I was able to determine the home they were looking for was actually going to be closer to $600K. But even better, based on the numbers they told me, $600K was actually well within their budget. We literally went and looked at the perfect home that day and contracted it at $615K. Now please don't miss this. They had spent over 6 months looking at over 30 homes under $450K. In just 10 minutes, with these two numbers, I was able to inform them that the home they were describing to me didn't exist under $450K, but that it did exist within their budget. And if you're not clear on this number, this exact same thing is going to happen to you. It happens time and time again. So if you come to me and say your max monthly payment is $4,000 a month, then I'm going to ask you, so if I find your dream home and it's $4,100 a month, I don't send it to you. And if you respond with, well, if it's the perfect home will stretch to $4,100 a month, then I'm going to ask you to revisit your numbers and come back to me with the actual top monthly payment for the perfect dream home. If you don't do this and give me an accurate number, I promise you, you are going to waste a lot of precious time. I'm saying this from experience, you just have to trust me on this one. And again, you don't need to go anywhere near the top monthly number, you just need to know what it is. Okay, so how do we actually find your absolute top monthly payment? Well, for those of you who are just here casually browsing for information, I'll give you some quick conventional math to get you started, then you can skip to the next chapter. But for those of you who are ready to get serious and invest the time and energy to get fully prepared, again, I'm going to give you my free calculator and we're going to walk through it step by step, and it's going to get you really close to that top monthly number. But a few things need to be said here. Neither your agent nor your lender are financial planners. Nobody in the world can tell you what you should spend. The only way you get clear on this number is if you take the time to make a crystal clear budget and know all of your personal expenses and spending habits. Two people can have the exact same income and totally different spending habits, and these two people need to be shopping for homes in completely different price points. A lender doesn't look at your spending habits. They only look at your income and your actual monthly debt obligations, not how much you spend on groceries, on gas, shopping, entertainment, or anything else. So making a solid budget is the one step that only you can do, and you absolutely need to do this before moving on to any other step. So let's start with the quick math. The most commonly accepted theory of how much you should spend on a mortgage is no more than 28% of your gross income. So if your household makes $10,000 after taxes into the bank account, then you take $10,000, you multiply it by 0.28, and by this theory, you should be spending no more than $2,800 a month on your mortgage. However, as I said, everyone's financial situation is completely different. I have many buyers who go quite a bit higher than this and still feel totally comfortable within their budget. Or some clients will say, well, instead of putting $500 a month away into a 401k, I'm now going to use that money to put towards a mortgage, since I see owning a home in a great area as an even better investment than a 401k. In fact, housing historically has had better returns than the stock market. Plus, you get to use leverage, which multiplies your gains. And then when you go to sell your primary residence, most people pay zero taxes on those gains, a benefit that you never get in the stock market. For example, if you and your spouse buy a $500,000 home and 10 years later you sell it for $1 million, you'll have made a $500,000 profit and you'll literally pay $0 in taxes on that profit. You'll get to keep the full $500,000. This is obviously not the case with other investments like stocks. So many of my buyers see owning a home as a better hedge against inflation than stocks, and they'll divert some or all of their investment capital towards the mortgage. So for this example, instead of $2,800, they divert that $500 that used to go to the 401k, and now they're at $3,300 a month. For context, by spending that extra $500 a month on the mortgage, they can now afford about $70,000 more house, which is a totally different house. A 400k home and a 470k home are two totally different things. This could be the difference between buying a 1,700 square foot home that's going to last you for 3 years versus buying a 2,200 square foot home that's going to last you for the next 10 years, all over $500 a month. Now, another thing to consider is if you live in a state like Texas, we have high property taxes because we have no state income tax. So whatever amount you would pay towards state income tax in a state like California, for example, you would put that amount towards paying your property taxes here, which means it would go towards your mortgage here in Texas. Does that make sense? So the 28% rule can't accurately apply all across the country because of all these different tax rates. So there's not even close to a one-size-fits-all answer, which is why I highly recommend doing this the long way using the calculator. So if you came here looking for some quick math, you can use that 28% rule. But again, if you live in Texas, this number should be higher than 28% because of the property taxes. So I would say move this number up to 1/3 or 33%. Just remember, this needs to cover your principal, your interest, taxes, your insurance, and your HOA. So if you were just here looking for some quick conventional wisdom, you can use the 28% or 33% if you live somewhere like Texas. Now, very quickly, the next question we need to answer is how much total cash you have to put towards this transaction, also known as cash to close. This includes both your down payment as well as your closing costs. And I'm not going to spend much time on the specifics of the closing costs in this video, but if you want to know all of them in very great detail, you can make sure to watch this video next. So starting with down payment, the quick math here is it depends on your loan type. If you're doing USD or VA, you can put 0% down. There are also a number of first-time homebuyer programs and grants that are going to tell you you can put as little as 1% down, but I've never actually had a client that these programs worked for, at least here in Texas. Because in order to qualify for these grants, you've got to have lower income and be buying in a lower income area. But because you're using these programs, you're going to have a higher interest rate, which means a higher monthly payment. So you're technically allowed to put almost no cash down, but the monthly payment is going to be super high. So it ends up not actually being very helpful because lower income buyers obviously can't afford a super high monthly payment. But the majority of you as first-time home buyers are going to be looking at either a conventional loan of 3% down or an FHA loan of 3.5% down. Conventional loans are best if you have decent credit, the fees are lower, the rate is usually a little better, and the mortgage insurance is lower. As well as on an FHA loan, putting the minimum of 3.5% down means that your mortgage insurance is going to stay on the loan forever. We're talking about hundreds of dollars a month in mortgage insurance insurance, you're going to have to pay every month for the entire life of the loan. With a conventional loan, however, that monthly mortgage insurance not only is cheaper to begin with, but it drops off your mortgage payment once you reach 20% equity in your home, which can happen in just a few years if we see some good appreciation. And on a conventional loan, you actually have the option to buy down all of that mortgage insurance up front in a lump sum. So for example, I had a little house I did this on once. My mortgage insurance was going to be $100 a month, and I was able to spend around $3,000 to just buy it all down up front. And I actually had the seller pay that $3,000 for me. So in exchange for $3,000, my monthly payment came down permanently by $100, and I was totally done with mortgage insurance right out the gate. This is not something you can do with an FHA loan. So looking at the quick math here, let's assume you're getting a conventional loan. You're putting the minimum down as a first-time home buyer, that's 3%. If you're looking at a $400,000 home, you multiply that by 0.03 and you get $12,000. This is your down payment. And this is a number that you have to pay. The seller cannot contribute anything towards your down payment. Now, you can get your down payment as gift funds from a family member. You can borrow against your own Roth or 401k, or you can even crowdfund your payment on something like GoFundMe. For example, if you're getting married, you could put on your wedding registry, people can contribute towards your down payment. It's a weird loophole where as long as it's crowdfunded as a gift and it's not just your friend directly giving you money, then you're allowed to use it. But outside of these options, your friends can't give you money, nor can the seller or anyone else for your down payment. But the seller can pay for the next number we're discussing, which is your closing costs. A good quick math for closing costs is, if this is just a regular home on the market, not a super competitive market, I would say 2.3% is a good rough number. So on a $400K home, multiply that by 0.023, that gives you $9,600. Now, if it's new construction or a competitive market where you may be in multiple offer situations where you'll have to pay the title policy, I would say budget in 3% for those closing costs. So at a minimum, you'll need your $12K down payment, but ideally you're gonna have all $21,600 because not every seller is gonna cooperate with paying all of your closing costs, or the market may just be too competitive for that to be a viable option for you. So $12,000 is totally possible, but $21,600 is best. And if you wanna learn more about how and when the seller can pay your closing costs, how much they can pay, what all the guidelines and limitations are there, you'll wanna make sure and watch this video next. So that's the quick math for these two numbers, but even if you're just here for quick math, I recommend coming back at some point and doing the full calculator. It is well worth your time, but if you're satisfied with the quick math, you can go ahead and move on to the next chapter below. For the rest of you who are ready to get crystal clear on your budget and exactly how much house you can actually afford today, then head to the description below and click the Max Affordability Calculator link, grab your budget and another cup of coffee, and let's get started. Also, this calculator will likely estimate lower than what you can actually afford. So don't be discouraged if right out the gate it gives you a number that's lower than you were expecting. Because in reality, you're probably gonna buy down some of your mortgage rate, you might buy down your mortgage insurance, or you might have the seller pay to buy down both of these. Another example is you might use some of your cash to finish paying off your car loan. If that were to free up, let's say $375 a month in your budget, you'd now be able to afford $50,000 more house. So the true amount that you're actually going to be able to afford is going to involve some strategy, which is why you need a great agent who can send you to a great lender, and we all work together as a team to figure this out. So just know this calculator is as good as it gets without getting any problem solvers involved for your specific situation. But in reality, you're probably going to be able to afford more than whatever this calculator tells you. Lastly, if you want to go through this live with me, you should be doing this from a computer. It is possible to do it from your phone's web browser or even the Google Sheets app, but trust me, you'll have a way better experience if you just wait till you get to a computer. Okay, step one, if you haven't already, go and download the calculator by using the link in the description below. This link will make a copy of the calculator, which is a Google Sheet, into your Google Drive. Think of it as an Excel spreadsheet, but you can access it online at all times through your Google account. So you do need a Google account to use this, but I would be very surprised if you don't have one by now. Also, because the file is getting copied directly into your Google account, we will never have access to any data you input in there. Your copy will live solely on your drive. If you've already done that, you can come down here to the bottom to page 2, which says your info. This is where we're going to input everything. So the first box we encounter, this is down payment. And what you can do here is, if you know the loan type you're going to use, if you're using USDA or VA, you'll be able to put 0% down. If you're a conventional first-time buyer, you can put 3% down. If you're FHA, you can put as little as 3.5%. If you're a conventional home buyer who already has owned a home within the last 3 years, then 5% is going to be your minimum. And if you want to put any more than that, just choose any of these. I always recommend putting down the minimum. I'm going to pretend I am a second-time buyer, so I'm going to put it 5% down. Here you just need to put in the current interest rate to see what today's rates are. Just click this link. This takes you to Mortgage News Daily if you're looking for a 30-year fixed, 15-year fixed, whatever you're looking for, FHA, VA, you just pick whatever's on here. So we're doing a 30-year fixed conventional. It's a 7.4 today. So we're going to go back to our calculator and we're going to type 7.4, hit enter. We want a 30-year though. If you wanted to do 15, 20, anything else, you can put it in there. Now, property tax rate, this is important as it's calculated on the total value of the home, but you just want to get as close as possible for now. So you can start here going to the property tax map. I live in Texas, so you'll see here it says 1.6, though the city and the county could potentially have more taxes. So you kind of need to do a little bit of research on your specific area, but this is a good starting point. So Texas has high property taxes because we have no state income tax. So this may be way high for you depending on where you're looking at. And here in Texas, it could be anywhere from 1.6 to 2.8%. Then you've got to factor in your homestead exemption, and then you've got to factor in that the county probably has the home you're buying assessed lower than the value you're going to purchase it for, so your taxes would be lower. So it's very hard to calculate it exactly. Just get as close as you can. Living here in Dallas, knowing I'm going to have a homestead exemption, I'm going to go with 2%. So just do your best. It's not the end of the world if you can't figure it out. The insurance rate, if you don't know, I would just leave the default number. 0.6% is pretty good. Now the mortgage insurance rate, anytime you put less than 20% down, you're going to have to buy a mortgage insurance. And the mortgage insurance is different for different loan types. So make sure you pick the correct loan type. I'm going to say conventional and I have good credit. I'm going to say use good credit as long as you're above about a 740. If you're under a 740, I would do fair credit, and this will change the numbers. So I'm going with good credit. The area I'm looking in does not have an HOA, but if you know that yours does, just look for an average HOA and make sure to put it in because that will affect your numbers greatly. Next important number is your tax rate. So based on the numbers you're about to put in, you'll be able to see your net income here, and then if you don't know your tax bracket already, you can click the link. So for the example we're looking at, I believe their net income was around $113,000 as a couple. So they would be between 94 and 201. So they're going to be at the 22% tax rate. So I go back here, I've already got it in there at 22%. So as you can see, this is very easy to use. You can knock this out in 1 minute. And then we move on to the next, which is income and debts. So if it's just you, you'll put your income here, and this is your gross income. If you have a co-borrower, your spouse, for example, you would put their income here. In this example, we have somebody making $85,000 with a spouse who makes $60,000. And if you've had a significant change in your income over the last year, I would recommend putting the average of your last 2 years' salary. And if you're self-employed, you're probably going to have to go to a lender to get an accurate picture. All of the write-offs you take count against you. So even if you make a lot of money, if you have a lot of write-offs, the bank is going to see it as you don't make very much money. So if you're self-employed like I am, don't worry, there are still plenty of strategies to get you where you need to be, but it's not something that's simple enough to cover in this video. So if this is you, just call me and let's talk through your situation. My number is in the description below. Okay, so you've put in your income for both people. Now we're going to look at your debts. Something important to know about debts is debts are things that have one big payment that we ultimately have to pay down. Expenses do not. Lenders don't care about your expenses, they only care about your debts. So car insurance, for example, you have to have it if you own a vehicle, but because there's never a lump sum that you have to pay down, it's not a debt. It's just an expense. So you can see here, regular debts people have: car loans, student loans, credit cards, personal loans, rental property mortgages, alimony, child support, anything that's required every month and has a lump sum that you pay down at some point. So in this example, our borrower one has a $350 car payment and he has credit card payments of $150. Now something important to note is you may be paying down more than $150 for your credit cards, but all the lender's looking at is what is the minimum required payment across all of your credit cards. So this person's minimum required payments on those credit cards is $150 a month. Then we go look at borrower two. Borrower two has $300 a month of student loans and a car of $350 a month. So remember, it's very important that you do not put your expenses in the debt category. And that's it. So this should take you like 2 minutes, and now we get to move on to the fun part, the affordability dashboard. So head down to the bottom and click number 3, your affordability dashboard. Okay, so what you see here at the top is our suggested maximum. We suggest a moderate financial comfort level. And again, this is the maximum suggested, so don't feel like you need to go here. This is not what you should do. That's going to depend totally on your lifestyle and your financial comfort levels. So this is a quick glance of what a moderate financial comfort level is, but as you'll see here, we have cautious, traditional, moderate, assertive, and risky. All these levels show you is how much of your net income is going towards your housing payment. So at cautious, it's only 24%. Traditional is 34%, moderate is 43%, assertive is 51%, and risky is up to 58%. And something you should also know is that different loan types have different limits. For example, if you're wanting to buy a $700,000 house with a minimum down of 3.5%, you're not going to be able to do it on an FHA loan because that would be outside of the loan limits. So if you're considering doing that or doing USDA, then you can click for more info here, as well as conventional loan limits, because there are limits to those as well. You can't buy a $1.5 million house on a conventional limit, at least not in most states. There are different maximums for some high expense states. So let's take a quick look at the map just to give you an example. So for example, looking at the conforming loan limit values map, if you live somewhere, for example, like Los Angeles County, your loan limit is actually going to be $1,089,300 for a single family home, whereas if you live anywhere in most of the other country, your conventional loan limit is going to be $726,200. So you take that loan limit plus whatever your down payment is, that's what you can buy on a conventional loan. So if you get a high number up here, just make sure to double check the loan limits if you're anything above 700. But before we move on, I want to take a quick look at this, even though it's obviously labeled information. If you were to go with the moderate level, which is 43% of your net income, you'd have a max purchase price around $439,000. Your total monthly payment would be just over $4,000, and you can see it all broken down here. Principal and interest would be $2,887. Your property taxes would be $731. Homeowner's insurance of $219. Mortgage insurance of $208. And of course, we put $0 of homeowners association. Your down payment, the 5% we wanted to put, is $21,942. But you also have estimated closing costs of $10,093, as well as you should keep in mind that a seller can pay for all these closing costs for you. The only thing that you have to come up with is this number, the down payment. That has to come from you. It can come as a gift from a family member, but a seller can't pay towards your down payment. But a seller can pay for all of your closing costs. Now there are limits. For example, on a conventional loan, a seller can pay all of your closing costs up to 3% of the sales price. But don't worry about that now, and I've made another video on that as well. So I'll link a few videos throughout here, and at the end, just make sure you go and watch them. The rest of the sheet is dependent here. You need to select the loan that best aligns with your financial comfort level, which we just referenced here. So if you think, you know what, I could go up to 43%, or you think I could only go up to 34%, you would pick traditional. For this example, I'm just going to stick to moderate. And if you're somewhere in between these two, don't worry, we're going to have you covered here in a minute, because most likely you are going to be. You're going to be not at 438, not at 347, you're going to be somewhere in the middle. But this drop down will change everything below, so make sure you select the one that most represents where you think you want to be. Next, we're looking at extra costs of owning a home, and this is just something to be aware of. These things may already be in your budget, but I just want you to be aware in case they're not. So obviously the mortgage payment is the biggest chunk of your expenses, but you also have to factor in utilities because you may be moving from a small apartment into a larger home. Or you may be moving from a larger rental into a smaller home, and then it goes backwards. But basically, this is just a helpful estimate to help you refine your budget. So let's say the homes you're looking at, you know they're going to be around 2,000 square feet. You have a drop down here. So I think that moderate is a good middle ground for everyone. If you have a very energy efficient home, you could put low, and then that drops it down to $120 a month instead of $200 a month. Or if utilities are already factored into your budget, you can put none here. And then your maintenance savings per year, this is, let's say, you get a big hailstorm and you need to pay the insurance claim for the roof, or you have a plumbing leak, or any number of these things. You want to be putting something away in savings. And again, that might already be in your budget. If it's not, we suggest doing moderate here, which is 0.5% of the purchase price every year, which comes out to $182.85 a month. So we're going to assume you didn't put any of those in your budget, so we're going to put them both at moderate. And this is going to give you a much clearer picture of the total housing costs. So it's not just the mortgage, it's also your utilities and maintenance. If you add those together, your estimated monthly cost actually goes up to $44.29 a month. So this is the number you need to look at. This comes to 47% of your total take-home pay of $9,425 a month. So after you've paid all of this housing expense, the number you need to look at is right here in the middle of this paragraph. After paying mortgage plus other costs, you will have $4,996 left over for all of your other expenses. That's your car payments, your groceries, your gas, whatever other bills you have. So $4,996 is what you would have to work with based on what you showed earlier. So now at this point, you go look at your budget and see how much are all of my other expenses. If they're less than $4,996, then this is probably within your budget. If your other expenses, including your savings, including your giving, including everything else, is only $4,000 a month, then this is actually pretty low. You're going to be saving an additional $996 that wasn't even in your savings category of your budget. So this would be well within your range at that point. And this is why it varies so much, because some people have very low expenses. Some people have very high expenses, and they may need this number to be more like $6,000 or $7,000 just to survive. So there's no one-size-fits-all answer, but this is the main number you're looking for. If $4,996 fits in your budget, then I would say you could afford this house. So let's keep going. We already saw this, the down payment. This just shows you the closing costs. Typical, I would say, is 2.3%. If you think it's going to be a little higher where you're at, or a little lower if you think the seller's going to pay for some things. Maybe you have to pay for the title policy because it's very competitive. You might move this up to 3%. But otherwise, I'm just going to leave it at 2.3%. Just keep in mind, it's around that $32,000 is what you should have. Again, the seller can pay for all of this. You can watch that other video which explains it in detail. Now we're moving on to what happens in those middle ground numbers that we were talking about. So your baseline is around that 439, but the next lowest in the drop down is 347, and maybe you know that's way too low. So let's take a look down here. Looking at your baseline of 49, you could go 10% lower and you'd be at 394. So that still may be a very reasonable number for you, and you'd be saving $405 a month versus the maximum. So this is just a quick math. If I want to go 5% lower, I'm at 417. $202 a month lower. So let's say you looked at your budget and you had that $4,998 number and you were actually $400 short, so you couldn't afford it. Well, you could come here and you see this is $400 lower, so I actually could afford about $395,000 house. And I'm going to give you another, and what I think is probably a better way to look at this is this calculator right here. This is estimating the change in mortgage payment per $10,000 change in purchase price. So what this means is, in order to afford $10,000 more house is only going to cost you $75 a month, as well as if you buy a house that's $10,000 lower, it's going to save you $75 a month. So if you're looking on Zillow and you see a house that's $400 and you see another house that's $410, you'll know that those two are only going to be a $75 a month payment. And another useful way to use this, as you'll see in that video I've been referencing, is if you need to wrap $10,000 of your closing costs into the loan, you'll know that that's just going to raise your monthly payment by $75. So if it's a $400,000 home and the seller's not budging on the price, you could offer $410,000 and have the seller pay all $10,000 of your closing costs. So you didn't have to come up with $10,000 out of pocket, and all that happened is your monthly payment went up $75, which is a lot easier for a lot of people than coming up with an extra 10 grand. And the last point I'm going to make here is this is why I always personally put the minimum down on the house, because every $10,000 you sink into this house is only saving you $75 a month. So I always ask people, what's easier to come by, $10,000 or $75 a month? Obviously $75 a month. If you buy this house, sink all your cash into it, and you have an emergency, you're now going to be cash poor, and that may even cause you to lose the house. Getting that money back out of the house is crazy expensive. You're either going to have to sell the house, which is very expensive, or if it's appreciated enough, you might be able to do a cash out refinance and get some of it back out, but it's going to cost you close to $5,000 to refinance. And you're going to have to deal with whatever mortgage rates are then. So just my personal opinion, I take the higher payment and I keep a stack of cash in the bank. Imagine this, you get laid off for 6 months. Would you rather have an extra $50,000 in the bank to live on, or a house payment that's $375 a month lower? Because that's a real scenario, and those are the actual numbers. $50,000 in the bank versus $375 a month saved. Okay, last part of this calculator is just this. You know your moderate max price, so that was your $4,046. Let's say you get on Zillow and you find a house that's $390,000. Then you can go, wow, that's going to be $450 a month lower. So you should be able to use this as well as your quick math of $10,000 to very quickly and easily know how much more or less home you can afford based on your budget. Now moving on, we have how do lenders look at your debt to income ratio. I'm not going to go through all this now because a lot of people don't care, but if you do, just read through this. It is an explanation of how they get to your max payment. They have a front end ratio, they have a back end ratio, and then they choose the lowest of those two. And again, I'll let you read through it. It's thorough here. That's how they come up with it. Okay, we've done it. We're as clear on the numbers as we can possibly be, and this info should help you make the first big decision, which is home buying actually feasible for my financial situation? And maybe you looked at this calculator and you're feeling a little worried. Maybe you've been paying $1,500 a month in rent and the calculator is saying you can go up to $2,500 a month for a mortgage, but that just feels like too big of a jump for you. My advice to you is start living today as if you were already making that future mortgage payment. Put the difference between your future mortgage payment and your current rent into a savings account every month. In 3 or 4 months of making that $2,500 payment to yourself, you're going to have a much better idea of whether or not you can actually do this. And as a bonus, you will have saved an extra $4,000 towards your down payment. So it's a win-win. Now, assuming you've gotten this far and you're still comfortable moving forward, the next step is going to be hiring an agent. Hiring your own agent. Do not use the listing agent. The listing agent has a fiduciary duty to only one party, and it's not you. The listing agent might say, "It'll save you $5,000 to go directly through me," which might sound like a great idea, except that if you had had your own agent, they could have looked at the comps and showed you that the house was overpriced by $30,000. Hire your own agent who has a fiduciary duty exclusively to you. This is way too big of a transaction for you to be unrepresented in. And finding an agent first will save you a ton of time. Don't go reading articles on Google, don't get on Zillow, don't even get pre-approved until you've hired an agent. Let your agent set these expectations and do the work for you. The internet is full of terrible and misleading advice and information. Your agent should be an expert in your market and should know all the best answers to any questions you're going to have. Your agent should now be your Google for your real estate transaction. And if you don't feel that your agent is competent enough to have all the answers, or is working in your best interest and is going to tell you the truth, then find another agent. But how do you find a good agent? By far, the best way is referrals. Ask your homeowner friends who they used and what their experience was like. Or you can call me and I'm happy to do the homework for you and find you a great agent in your area. I've interviewed many different agents in many different states, and I'm happy to do it for you as well. And if you're looking in the Dallas-Fort Worth area, give me a call. I'd love to help you find the perfect home. Now here are my top 5 questions that you should ask prospective agents. Question 1, do you work mostly with buyers or sellers? You may be surprised to know that most real estate agents work more with either one or the other, and it's rarely balanced. So if you're looking to buy new construction in Collin County and your agent has worked almost exclusively listing homes in Dallas County, they may not be the best equipped to help you in your purchase. They may be lacking a knowledge of new construction, the varying tax rates of new build communities, the most current builder incentives, and they may just never spend any time in Collin County even though it's only 20 minutes away. Now, this is not to say that they can't learn all of these things and serve you well, because many agents certainly can. But this is just something to consider. The next question is, how many homes have you sold and how many in the last year? You might be surprised to know the average agent only sells between 2 to 8 homes a year. Don't assume that just because someone has their real estate license that they've even sold any homes. A lot of agents don't even own the home they live in. Having a real estate license doesn't mean much, unfortunately. You can get started today and have your license next month, and you're going to leave that licensing exam having absolutely no idea how to sell or even price a home. The value proposition of every agent is going to be their knowledge and experience. Those are the things you just can't buy in a course. So the more homes sold, the more experienced the agent, the better equipped they're going to be to represent you well. And if it were me, I would rather work with an agent who sold 20 homes in the last year than an agent who sold 5 homes on average for the last 10 years. Because I would want someone with plenty of current market experience, because the market changes every month. And if you know someone who just got licensed and you'd like to give them some business, that's perfectly fine. But you want to make sure that they're either a part of a team who has an experienced team lead, or they have a direct mentor with lots of experience who is going to be the one actually overseeing your transaction. You may want to ask to meet with both them and their mentor, and you can ask all of these same questions to their mentor. Again, this is too big of a transaction for you to just hope for the best. The next question is, how long can I expect to be looking for a home? When you're looking for a home, timing is everything. The last thing you need is to get stuck in an expensive month-to-month lease. Ask your agent how long it usually takes before their buyers are under contract. I can tell you confidently that the vast majority of my buyers are under contract within 30 days of us having a buyer's consult. And many of them contract on the very first home we look at. You've got to realize the agent's job isn't just to do the paperwork and walk you through the transaction. The agent's job is also to find you the perfect home. I don't ever set my buyers up on a home search. That would be a waste of their time. 99% of the homes in the search aren't going to meet their needs, goals, or expectations, so why would I waste their time by sending them those homes? I set myself up on a search for them, and when the right home comes up, I send it to them and we go look at it. And more often than not, we'll contract it. The next question is, what happens if a listing is only offering a 2% or reduced commission? This is something you'll encounter more on lower priced investment type homes. Your agreement with your agent is probably going to be for a 3% commission. This is because most sellers are offering a 3% commission to the agent that brings a buyer. So for the most part, you will never pay your agent's commission, the seller will. But like I said, these low-priced investment properties many times are only offering a 2% or a 2.5% commission, and most likely your agent will be happy to take the lower commission and isn't going to charge you the difference, but it's still a good conversation to have up front as your agreement with them will be signed at 3%. The next question is, what are your current thoughts on the real estate market? A well-informed agent will easily be able to give you their thoughts. as well as why they believe them. They should have knowledge of past data, market cycles, what's happening this month, where mortgage rates are, and what all of this means for you as a buyer. Every single week I do a weekly market update on my YouTube channel of the local markets here, and one big reason I do it is to make sure I'm staying informed. The market changes very quickly, and I've got to stay on top of a lot of things to make sure I'm advising my buyers the best that I can. So if you want to see an example of what kinds of things your agent should know, you can click here to check out my latest weekly market update and look at some of the topics I cover. And don't be afraid to ask your agent specific questions. An experienced agent will be able to answer them. Trust your gut on this one. If your agent seems like they don't know what's going on, they probably don't. Hiring the right agent will determine more of the experience you have in this transaction than anything else. So take it very seriously. So we've worked out our numbers, we found an agent. The next step is going to be finding a lender. This should happen immediately after hiring your agent and certainly before looking at any homes. Your agent should have a local lender that they've worked with for years, who is an expert problem solver and takes great care of their clients. Someone who picks up the phone every time they call and always closes on time. Just like all agents are not created equal, it's the same with lenders. Choosing a bad lender can blow up your whole deal, whether they have bad appraisers, whether they don't close on time, or whether they just won't pick up the phone more than once a week. I actually had to deal with a client who insisted on using Bank of America because that's where their accounts were. And we were a full week past our close date and no one at the bank would answer my calls. I was leaving like 5 voicemails a day and no one would respond. In that scenario, the seller would have had every right to terminate our contract and keep my buyer's earnest money. That's thousands of dollars, all because the lender wasn't doing their job. Now, I'm sure plenty of other buyers have had a great experience with Bank of America, but I haven't, and in general, that's been my experience with all the big box lenders. And I can also tell you, I always have a great experience with my preferred lenders. So please listen to your agent's lender recommendations. Think of this like you're hiring a team. Don't make the quarterback of one team work with a random receiver that neither of you have ever heard about. Let your quarterback bring his all-star receiver. Football analogy. Okay, once you've found your lender, now you need to get pre-approved. Now, before you reach out to any lenders, you're going to want to get all of the following documents and put them on a folder in your desktop. This is 30 days pay stubs, 2 years tax returns, 2 years W-2s or 1099s, 2 months bank statements, and a copy of your driver's license. And if you don't have all of this handy, it's likely that your HR department will. So once you've got all your docs, then you reach out to the lender. The lender is going to send you a loan application. It takes about 15 minutes to complete just to get your basic information, where you work, how much cash you have, where you live, and they're also going to get your social security number. So the initial application is very short, and something important to ask these lenders is, are they going to do a hard pull or soft pull on your credit at this time? Obviously, the hard pull is the one that can hurt your credit, and because of this, a lot of people are hesitating to get pre-approved. But you may be surprised to know that many lenders these days are actually only starting with a soft pull, and this is something new that I've only been seeing for maybe the past year or so. However, if they do have to do a hard pull right out the gate, it's not the end of the world, and it should only move your credit score maybe up to 5 points. And regardless, if you're really looking to buy a house, they're going to have to do this hard pull at some point anyway. And also, once you get your credit hard pulled, you can have as many other lenders as you want do a hard pull as well, and it's only going to count as one hard pull on your credit. So your score isn't going to drop 5 points every time a lender pulls it. As long as you do it in this 45-day window, all of those pulls are only going to count once. So you did the application, they did the soft pull, now they're going to need to see your documents supporting everything that you put on your application. So all the docs that you already got in order before, usually you can either just email them over or they'll have some kind of portal that you can upload them into. Once you've done all this, they're going to give you a closing cost estimate. This gives you the estimated mortgage rate and all the estimated fees and costs. And if you want to know more in detail about all of these specific lender costs and how to properly read this loan estimate, that's all outlined in detail in this video. Now, at the end of all this, you'll have your pre-approval letter in hand and you're ready to go. And one last thing I'll say, when you're comparing lenders, the lowest cost does not mean the best. You get what you pay for. Basically, if the lender is offering a low rate, what that really means is they have less staff, because all of these lenders are working off the exact same base rate, and then they add their fees on top to pay for their staff. So you may go with a low rate lender, and they may only have one underwriter working for 10 different loan officers making $40,000 a year. The odds that this transaction is going to go smoothly or close on time or at all might not be that high. Again, ask your agent. I'm sure they have plenty of stories. I keep saying it, but this is too important of a transaction not to work with the best. Trying to save $500 here could cost you thousands down the road. Find the best and pay them appropriately. Okay, after you're approved, do not do anything that might impact your credit score or financial situation without first consulting with your lender. Some examples of this would be, don't pay off your car. Don't buy a car. This happens all the time. It's a joke in the agent community. Don't open a credit card. Don't max out a credit card. Don't buy furniture on your credit card before your home closes. Don't change or quit your job. Don't move large amounts of money in and out of your account, or you're going to have to show the whole paper trail, not just from your account, but from the other people's accounts they came from, and it's a huge pain. Any one of these things can blow up your deal, or at the very least, leave you with a higher mortgage rate, which then means you can now afford less house. Okay, next step in the process. This is the exciting one. It's time to go shopping. Your agent by now should have done some form of a buyer's consult with you where they zero in on your specific needs and wants, and your agent should now be hard at work finding you the perfect home within your now crystal clear budget. The number one thing I need you to hear me say right now is if you find a great home, even if it's the very first one you look at, do not pass on it because things happened too quickly. There are less homes on the market today than ever, and your choices are going to be extremely limited for the foreseeable future. The way I say it is, if we walk into a home and all parties agree that this is at least an 8 out of 10, then we need to offer on that home. So many times buyers have passed on a truly great home because it happened too quickly. They believed that they needed to look at more houses to really get an accurate picture. And ultimately, they ended up having to settle for something they didn't love as much at a higher price with a worse interest rate further down the road. If you walk into a home and it's an 8 out of 10 or better, offer on it. Don't take it for granted. Don't think that just because it happened once, it has to happen again. It doesn't. So now you've found your 8 out of 10 or better home. The next step is writing the offer. Now your agent will send you comps and tell you what they think is a reasonable offer and why. Comps is just a short way of saying comparable sales. We look at what other homes in similar conditions with similar upgrades in the immediate area have sold for in the last 30 to 90 days. Then we make adjustments to the price based on our experience and will recommend you an offer. But equally important to the price are the offer terms. So all of these are things that your agent will be able to recommend you based on their knowledge and experience of your local market. Make sure you listen to your agent's recommendations. Your agent is the expert, and the reason you hired them was for their knowledge and experience. So trust it. Then your agent will formally write all the documents, you'll sign them, and then we submit the offer to the seller. The seller can either accept or they might counter your offer. But at the point the seller signs the offer, the contract becomes legally binding and you are to hold to all the terms that were in that offer. Now every state has different contract terms, so there's no way for me to go through them all. But if you happen to be looking in Texas, you can check out this video where I walk you through all the major contract terms that you're going to need to know. But basically, once you're under contract, there should be a period where you can get inspections, and if the inspection goes poorly, you can either negotiate or you should have a way out of the contract for a small fee. Again, this varies by state, so ask your agent. Now, you've got an offer accepted. Congratulations. As I mentioned earlier, typical contract to close is going to be 30 days. So from the time you contract, you're very close to the finish line. But most likely what happens here is you'll get your inspection, you'll renegotiate repairs, or maybe you'll ask for money from the seller to do repairs yourself. And in many cases, I actually do recommend getting the money from the seller to do the repairs yourself because that way you can control the quality of who's doing the work. Also, in order to have a valid contract, you're going to have to deposit earnest money with the title company. The title company is a disinterested third party. They just handle all of the money exactly the way that it's written in the contract. Now, earnest money is negotiable, but it's typically around 1% of the sales price. It's known as good faith money, and it just shows the seller that you're serious. Usually, the only way you lose your earnest money is if you break your end of the contract. In many states, the seller has the right to liquidate the earnest money as damages if you break your end of the deal. So do not break your end of the deal or it's going to cost you thousands of dollars. Again, ask your agent how this works in your state. Now, once all repairs have been agreed to and you're moving forward with the house, you then move on to the underwriting process with your lender. So the lender has enough data from your preliminary documents to believe that you're good for the loan. But now that you're under contract, they're going to triple check every little thing they can. They're going to ask for docs, then they're going to ask for more docs, then they're probably going to ask you for the same docs 2 or 3 times. I don't know why this happens. It's very frustrating, but it always does. But remember, at the end of the day, they're about to wire you hundreds of thousands of dollars. So just send them the docs. Then eventually, after enough docs, the underwriter will give you a conditional approval. The conditional approval means you're all good to go, and once you provide these final, very final docs, and they'll give you a list, you're clear to close. Some other things that will happen during this underwriting period: the repairs are being made that were agreed to. You'll need to shop for homeowners insurance, and this is an important one because it can vary a lot. It is worth shopping for. And I personally always start with whoever I have my car insurance with because they'll be able to do some kind of bundle. But your lender should also be able to recommend a good insurance agent that they work with. In this time, your lender will also get the property appraised. The appraiser is an independent third party who comes out to give their opinion on the value of your home to the bank. As long as the appraiser thinks your home is worth at least the price that you've contracted it at, then the bank is happy and feels safe and will lend you the money. The appraiser is there to protect the bank from making a bad investment. Now, the lender will lend on the lesser of the contract price or the appraised value. So if you're under contract at $400K and the home only appraises for $390K, the bank is only going to lend on $390K. So in this case, you could either pay the $10K difference with cash out of pocket, or you could come back to the seller and try to negotiate and meet in the middle, or try to get the full price reduction down to $290. But worst case, if you don't have the $10K and the seller doesn't want to come down at all, there should be a provision for you in the contract where you can walk away from the home and get your earnest money back. Again, ask your agent. And I also want to say, there certainly are bad appraisers. This is another reason why it's super important which lender you choose. If your agent has worked with a lender on the last 100 deals and never once had an issue with an appraisal, but you decide to go with a discount lender, you have no idea the quality of the appraisers. They may send an appraiser that lives an hour and a half away that just got licensed that has never even stepped foot in the city that your home is located, and they're somehow expected to give a fair and accurate valuation. But just know, a bad appraisal means you're either going to have to pay more out of pocket or possibly have to walk away from your dream home entirely. Okay, moving on, our next step is clear to close. You got the conditional approval, you sent over all the conditions, now you're clear to close. So at this point, it's almost time to get to the closing table. Repairs have been done, your home has met the appraisal value, and all is well. Your lender is then going to send you a closing disclosure. You're going to see all the final terms that you're going to be agreeing to on the paperwork, including your rate, your final closing costs. The title company is going to balance all the numbers, including prorated numbers from the seller, like how much taxes they pay versus you pay. And once it's all balanced, title is going to send you your final cash to close number. Then you're going to schedule a closing time with title and a final walkthrough of the house. The final walkthrough is your last look at the house before you sign, and it's yours. So in your walkthrough, you'll check that all repairs have been done, the roof hasn't caved in, nobody smashed in a window. You want to flip all the light switches, run the AC, flush the toilets, check whatever you can, because once again, after you sign for this, it's all on you. Now we need to talk about a very important topic. This is wire fraud. Before you wire any of your closing funds, please pay close attention to this next part. I've actually had this happen to one client, and I've heard many similar stories. It's why in everyone's email signature, from title, from agents, everyone, there's always a disclaimer about wire fraud, because it's a huge deal. The way wire fraud works is this. There is a hacker somewhere. They will hack into one person's email account. Only one person. Could be the agent, could be the lender, could be you, could be anyone at the title company. Literally anyone in the email chain. They just need to get into one person's email. This allows them to follow the thread of the transaction and see exactly what's going on and what step you're at. Once they see that it's time to wire the funds, they'll make fake accounts for everyone in the thread to make it look realistic. They'll copy email signatures. They'll do everything they can to make you believe that they're sending you a legit email from the title company and make you believe that these are legit wiring instructions. If you follow their fake instructions and you wire money to their account, there is no guarantee that you will ever get any of your money back. This is a big deal. What I do is I find my title company on Google, I call the official listed phone number, then I ask for my specific closer and have them confirm the wiring instructions with me over the phone. So it's a big deal, and if it's too stressful for you, you do have the option of bringing a cashier's check. The only thing I'll say is, if you want to bring a cashier's check, I recommend getting it the day before. If you wait till the day of, there may be delays or issues you didn't know about, and you may not be able to close on time. Okay, now that you're fully informed about wire fraud, the next step is going to be closing day. This is it. The house is ready. You've done your walkthrough. You wired your funds successfully to the title company. You go to the closing table. You sign all of your documents. And as soon as both parties have signed and all the money involved hits the title company's bank account, the transaction is considered closed and funded. And at that point, you get the keys. So congratulations, and I hope you didn't forget to schedule your movers. A question I get asked often is, are all parties at one closing table? I don't know how it is in other states, but here in Texas, no, buyers and sellers sign at different times in different rooms. But I have heard that in other states, a lot of times people will be in one room, which I think could get pretty awkward. If you're buying cash, this process will only take a few minutes, but if you're getting a loan, you want to give yourself at least 45 minutes to sign all the docs in case you have any questions. Well, really, I would say if you have no questions, I would say it's probably 30 minutes. If you have a lot of questions, I'd say give yourself an hour. So I'd say 45 minutes is a good middle ground. Okay, everyone, what a journey this has been. If you made it this far, I honestly can't believe it. If this video was in any way helpful to you, please give it a thumbs up so more people can see it, and consider sharing it with a friend who may be early in their home buying journey as well. Please don't forget to watch all the other educational videos I referenced. There's a lot of knowledge in those as well. And as always, if you're looking to buy or sell in the Dallas area, just call, text, or shoot me an email. I'd love to connect. Thank you for watching, and I'll see you in the next video.